In this video, I want to talk about how to scale from $100,000 to $500,000 selling options without blowing up your account. And this is actually simpler than you think. The only caveat here is just making good decisions and staying or keeping to the plan. So I want to go over everything that I do. And my name is Eli. I manage over $9.1 million. So I have a pretty good insight of how you can get this kind of return even on a huge amount of money, even though most people watching are probably, their accounts are probably under $9 million. But it is still very doable to go from 100,000 to 500,000 in 4 years. So let's begin with how to scale from a 100K to 500K in 4 years. So all you need to do for that is, and obviously it's, it's gonna go from more complicated to just simplified. So 51% return per year compounded is basically what you need to get to achieve this goal. Now, 50% return per year is not that easy. It depends on the year. Some years can be better, some years can be worse. It really depends on the market, right? So for myself, I've been able to average 51% return per year. And this doesn't include this year, 2025, which I'm up about 24%. It's been really tough with Trump. And if you've been trading through 2025, you know exactly what I mean. So this year is definitely going to lower my average. But, maybe next year we will have a much better year and return 60, 70%. And this will kind of get the average closer to 51%. So my point is, you cannot get 51% every year, but you can average 51% depending on the year, of course. So 51% return per year, it's about 3.5% return per month compounded. So again, nothing too crazy. Obviously, if you trade with millions and hundreds of millions, this is not as simple, but we're talking 100K to 500K, which is very doable. Now, how can you get 3.5% return per month? On average, again, some months can be more, some months can be less. We are talking averages. So collecting 6 to 8% of account capital and credit per position. This is my rule of thumb. Now, usually my average is like, I usually collect around 5% of the account in credit. I try to collect more, but it depends on the year. Some years, if they're not as volatile, the margin requirements are much lower, so you can collect more. Some years, like 2025, margin requirements are up in the sky. Basically, they're huge, they're very large, so you cannot collect as much credit, right? So if you have a $100,000 account, you will collect about $6,000 to $8,000 in premium per position. Very simple. And you can also buy T-bills that currently it yields 0.3% monthly on account, actually even less now. We just had a rate cut, so but this is optional. Not everyone is doing it. It's fine. By the time you're watching it, rates might have gone even lower, so there's no point doing it. But I'm just putting it out there. So total positions needed to close for a profit is around 12 position. So basically one trade a month, which is very, very doable. Obviously, there's usually more opportunities every month, but let's go for 12 trades a month. And obviously losses are part of the game. So I risk one to make one, and we'll go over the position management in just a second. So with losses, total positions needed is closer to probably at least 15 positions a year. So I had actually, now it's 4 losses in 3 years, right? And they were all pretty small losses, or up to the 1-to-1 ratio. So it's not too bad at all. So next thing is we will let fundamentals dictate your position entry and exit, and this is a huge one. People don't do it, and I'll go over exactly what it means in a second, but you have to follow the news. You have to understand what's going on, specifically when you trade commodities, options on commodities. Trade moderate size, trade only when the odds are clearly in your favor. And again, fundamentals can clearly indicate our entries, as you will see in a second. And like I said, I work with over $9 million currently, and it is possible to get 51% per year with extremely low risk on average. So let's go to the next slide. Strategies, management, position size, and everything else. So these are the two strategies I use. Short strangle, short puts, I never sell short calls because commodities, they crash upwards. I don't want to have any exposure, any directional exposure to the upside unless it's a short strangle where I'm more neutral. So the take profit is at 25 to 50% of credit for both puts and short strangles. And ideally, I want to take profit at 50%. It depends. Sometimes the market is, giving you 25% very quickly in a day or two. So you're inclined to just kind of take it. Now, stop loss is 50% of credit received. And stop loss orders are only available in Interactive Brokers for futures options, if you didn't know that. But overall, I don't really use them anyways. I just kind of exit manually if I need to. I usually try to keep the losses under 50%. My last loss I took it at 40% of credit, just because fundamentals, which again, we'll go over exactly what it means, and we'll go over a full example. For short puts, I'm looking at a stop loss of 50 to 75% of credit. It really depends because puts are directional, but I want to stick to the 50% stop loss, or at 50%, you can roll or adjust the position. Everyone has their own kind of strategy. I usually tend to just close the position, but it is what it is for everyone and how they choose to defend their positions. So I'm collecting up to 8% of my total account premium in premium for short strangle, and up to 6% of my account capital in premium for short puts. So again, short puts, because you're very directional, you want to keep position size smaller than a short strangle. And again, this is up to, right? So I usually collect just way less, but some years you can collect quite a bit of credit and have a pretty awesome year. So I exit positions if there's less than 21 days to expiration left due to gamma risk, and gamma is the change of the rate of change of delta. And I will exit the position if there are major critical news that move the price and fundamentals have shifted. I don't roll options. If I do, it's gonna be really super rare. It usually doesn't make much sense to me. I just exit the position. And this is the rule of thumb. Margin requirements need to be up to 30% of account per position. So if you collected, let's say you have a $100,000 account, you collected $5,000 in credit, you need to make sure that you're not using more than $30,000 in margin requirements, right? Margin requirements can inflate, and margin requirements are different in every country, even in every broker, really. So I'm located in Canada, so our margin requirements are usually much higher than the rest of the world. And Interactive Brokers usually also have pretty high margin requirements, which is a good thing. It makes me, forces me to keep my positions small. But this is a rule of thumb. You can never break it. If it's whatever 32% of the account, it's still okay. But you never want to go 40, 50, 60% for one position, which is what a lot of people do. Then they can get a margin call. So let's continue next to the trade selection process. And this is where we can get into the fundamentals. And I promise you, this is really simple. This is what I do all the time. So step number one, I check if CVOL is relatively high. And CVOL is the commodity volatility index. So for me to sell anything, any kind of option, put options or strangles, I need volatility to be relatively high. If it's not, then I have nothing to look at, period. When we sell options, we sell volatility, and if you think otherwise, you will get burnt at some point on some position down the road. So, and I've been through it many times. This is the only way to really sell options on a high level. If you look for relatively high volatility, and obviously we will go over this trade selection process in full detail and full live example in a second. For now, step number two, I will analyze the chart. Is it an uptrend, downtrend, or a side trend? Very simple. I want to basically answer myself, okay, are we uptrending, downtrending, side trending? And based on that, I can maybe choose or maybe think about it, short strangle or a short put. And step number three is I analyze the fundamentals of the product. And I basically ask myself three major questions. Is there a fundamental reason for the price to go up? And is there a fundamental reason for the price to go down? And the third question is, are the news that caused CVOL increase critical or non-critical? And here you can see the combination of answers that we have. So we have yes, no, yes, which is selling short puts. Yes, no, no, selling short puts. Then no, 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 selling short strangles. So basically, I want to make sure that if I'm selling a short put, there is no reason for, or no fundamental reason for the price to completely crash down on me, right? And if I'm selling a short strangle, I want to make sure that there's no fundamental reason for the price to go up or down really sharply. And every other combination is just a lower probability setup. You know, you can profit from lower probability setups, of course, but they are lower probability, right, for a reason. And we are looking only for the best, highest probability trades where we can feel comfortable opening them. So step number 4, which is the last step, is look for a good position. And this is where we just open the option chain and kind of see what what credit we can get, what is the margin requirements, so on and so forth, which is what we talked about in the previous slide. So let's go over a full example so this all makes sense. And you have to remember, for the fundamentals, you do need to kind of learn a little bit how each product acts, what is the supply and demand balance for each and single futures product or commodity product more specifically. And it's not that complicated, really. You can use any AI chatbot to help you with that, but it is something you have to know. And again, if you have any questions, let me know about them, about fundamentals, because I know this is where most people actually struggle, and everything else seems to be much easier. So let's go over a live example and take a look at a possible trade. So step number 1 is to check the commodity volatility index, which is right here. It's completely free. You just need to sign up with them. You can just either Google CME CVol and sign up with them, or you already have access to it. It's free. There's no need to pay for anything, but you just need to sign up. So let's look at the few products that I'm working with. So I'm really working with gold, silver, copper, crude oil, natural gas, wheat, corn, and soybean. These are the only products that I work with. Therefore, I'm pretty familiar with the fundamentals for each and every product, and I have a pretty good understanding of what's going on, right? So it's about quality and not quantity, and just being able to really understand the fundamentals of each and every product. So if you look at silver, we have a pretty relatively high volatility, and I'm looking at the 3-month volatility. This is usually the cycle I'm looking at. So this is the lowest point, and this is the highest point. So we are way closer to the upper side, and we are closer to the high. So this is a very good volatility. If you look at gold, let's take a look. So gold is, maybe somewhere in the middle. So this is, I would not consider this good volatility, at least for now, unless it goes up a little bit more, at least. With copper, well, copper also has, it's better than gold. It's closer to the highs. I would consider this an okay volatility. If it would have been a bit higher, over the 30s, it would have been just fine. Now we have natural gas. Natural gas is obviously very good volatility, relatively really high. And then we have crude oil. Obviously, you can see it's really low, so no point for me to be looking at it. Corn is also pretty low currently. Then we have wheat and soybean, and I just know because I already checked, but wheat is also pretty low, and soybean is also at a pretty low volatility. So you can see it's basically at the very bottom. So we have silver, we have natural gas, and that's about it really. And copper is kind of in between. Now I can tell you that I opened a position on copper just a day before making this video, because volatility was a bit higher, and it was like perfectly fine for me. But for this example, let's say, you know what? Let's look at copper, because with silver the price has gone up so much, which at this point it's overbought. So to a point where I don't feel comfortable selling any puts on the product. So let's look at copper and pretend that today is yesterday, and volatility is a bit higher than it is right now. So we're looking at this chart over here, And our step number 2 is to figure out, okay, is it uptrending, downtrending, what's going on? And this is a clear, slow moving uptrend, right? You can see it's not overbought. It's a nice uptrend, right? So if it's an uptrend, obviously there's no reason for me to be selling here a strangle, right? It's only ever a short put. I don't want to be selling a strangle on an underlying that is uptrending. I'll show an example where you would potentially want to sell a short strangle. Let's see what's going to load up. So price has been moving sideways for soybean here for quite a long time. So here I have taken a few short strangles. Obviously it broke out right now, but it's been moving within a big side trend for quite a while, and this is obviously very good for a short strangle. For now, again, let's keep looking at copper. So we know volatility is relatively high. We can easily say this is an uptrend. There's really everything is really simple so far, right? Next thing is we're looking at the fundamentals, right? So how can you look at the fundamentals? Well, I'm really just kind of reading the news here. I'm just reading it, every day, every time something kind of comes out. But you can just kind of click on it and see if there's anything, if there's anything about the 3 questions that we have, right? So copper prices shoot to a new record high, boosted by a Federal Reserve interest rate cut this week. So we had a rate cut, which is pretty significant news, and a rate cut is really bullish for metals because it creates cheaper debt and more demand, and then this copper really in anything and everything. So futures on the London Metal Exchange trade at blah 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 after touching an intraday. Prices have risen nearly 35% this year. The combination of lower interest rates and stronger economic growth should boost copper demand, right? And if we know if demand goes up and supply stays the same, price should go up. The rally is also driven by persistent concerns over supply squeezes due to heavy stockpiling in the US and a series of mine disruptions this year. So I've been obviously reading the news for copper for the past few months every day, and there are some major mine disruptions which tighten supply, obviously, and we have heavy stockpiling in the US. Basically, companies buy more and more copper to stockpile because in the middle of next year, of 2026, there are expected to be some kind of tariffs or a possibility of tariffs on refined copper, which is obviously going to be not good for U.S. companies. So they're just going to buying right now. So for now, first question is there a fundamental reason for the price to go up? Well, there are multiple reasons for the price to go up. Next question will be, is there a fundamental reason for the price to go down quickly? Really, there isn't any specific reason. Really nothing. All right, there's and this is not just based on this piece of news. It's generally, generally speaking, if you do your research a bit deeper than that and you go to an AI chatbot, even though just looking at the news here and reading them just back like a week and just keep reading it, seeing what it says. So currently I'm making this video is December 12th. So we can go well over a few weeks and look at all the news and get a really good story of what's going on. But this piece of news really summarizes, or it's not this one. I think it's this one. Yeah, but this piece of news summarizes everything perfectly fine that has been going on for the past few months, really, with copper. So it's pretty good. And last question is, are the news critical or non-critical? The question is, the news are pretty critical, right? We have mine supply disruptions, which is pretty critical. And obviously we have the rate cut, which is, again, pretty critical, very bullish. And the news about stockpiling in the US as well. So these are pretty critical news. These are news that will affect the supply and demand going forward, right? So if the news are, let's say, a report of a big quantity of copper that has been sold in the past 12 months, then these are non-critical news because it has no indication of what will happen going forward for the supply and demand, right? This is just news from the previous 12 months. It's just a report, right? But here we have, basically we have reports that will keep affecting the supply and demand balance going forward in time, right? It has nothing to do with what happened in the past, right? So this is how you know it's pretty critical. If you ask yourself, is it going to affect the supply and demand balance? The answer is yes. Then obviously this is a red light. So news are critical. There's no reason for the price to go down. There is a reason for the price to go up. So we have a yes, no, yes, which is a short put. And obviously, because it's an uptrend, we are always also going to be getting a short put. And you will see it goes hand in hand, the combination of the answers and how the price of the underlying is moving. Basically, every time it will be a short put, you will see that the price is probably going to be uptrending, right? So we're looking at a short put here, which is the last step, pretty much looking for a short put. So I'm currently at the March expiration. Let's go and see what we can potentially get in the option chain. So ideally, I want to stay around 45 days to expiration. Not always possible. Sometimes you cannot get enough credit, but let's say this is what we want, right? And at the same time, let's also cancel the replay because the price is already moved, right? So I can tell you the exact position I opened, because I opened the 4.9 strike and I opened it on this day over here. So why did I choose this specific strike? Because this is basically the previous consolidation of the price and I want to be underneath it, right? So ideally you want to be underneath maybe even this, this low over the past few months, but at this point you cannot get enough credit to justify the risk you're taking. So this is plenty far, and I was looking at a strike around this range. So I chose 4.9. Now it's going to be a bit lower credit because the position is already nicely profiting. I think it's up 6 or 7%, which is not too bad. But let's say for the sake of example, we're looking at this position right now. So it's $575 in credit per contract. And let's say we have a $100,000 account. We can see the margin impact is $9,400 for one contract. So we can go a max of 3 contracts because I want to make sure I'm under 30,000, which is 30% of my account. So I'm looking at about $1,725 in credit. So I collected closer to $2,000 here, which is not too bad, obviously, and price and volatility went down since, but it's obviously also a pretty respectable premium. And I'm going to be taking profits at half of this amount, which will be, what is it, 862.5, give or take. And we have the theta here, which is $70, and which means we are going to be in a position for closer to maybe 12 days, give or take, right now. For me, when I opened the position, theta was higher, and it looked more like we'll be in a position for about 10 days. But let's say you don't know that this is the strike you want to select. Again, let's go over the strike selection, because this is where a lot of people kind of fall. They don't know if they should go really far out of the money or not too far out of the money. And the reality is you shouldn't go too close to the money and shouldn't go too far out of the money. If you have a profit target, a loss target, best thing to do is kind of look at the graph and analyze and go below the previous swing. So, let's look at another example for a short strangle for the strike selection, right? So let's put it here, and I think, let's see here, replay, because I'm pretty sure I opened the position. Let me see here. I think it was stay over here. Or actually, yeah, so this is where I've opened a position. Price was, actually, I think it was the day before. Yeah, the day before. And you can see price has been clearly moving kind of sideways. So I don't remember the exact strikes, but it was something like that. It was, actually, I do remember it was 1110, and it was, I believe, 980, give or take. So you can see, and price was actually a little bit lower. If I remember correctly, but you can see here it's really simple. You can see where the price is moving within, and you want to be outside of that range to the best of your ability, and you want to be equal distance as much as possible. Again, price was a bit lower, so this was the dead middle when I opened the position. So pretty simple, I think, and it worked out pretty well. Position was profitable very quickly for the most part, and nothing too complicated. So same thing with copper. Let's remove the replay. So same thing, I will just go underneath the previous swing. Let's look at another one. Let's look at silver. So silver, for example, is a bit more, a bit different because the price has been kind of moving up and up and up. But this is kind of the last solid ground where silver has been kind of somewhat moving sideways within, right? At least on the low range. So I would probably look at 46, maybe 47, which I did actually look at. The issue is you don't get enough credit here. So let's take a look actually, and so you know exactly what I mean. So silver futures, or we don't need that. Close. Silver futures, and we are looking at the March expiration. So let's look at strike 47 and see what kind of credit we can get. So strike 47, and ideally get 46 days to expiration. So strike 47, and we have to go really far out of the money. It's gonna give us, let's see here, and so this is gonna give us maybe $540 in credit, probably a little bit more because the bid and ask spread is quite big, and it shows me the worst possible premium. But let's say it's $540. You can see the margin requirement is 15,000, so I can really only take only 2 contracts, right? And at this point, I'm looking to take profit at half of this amount, which is $500, give or take. So for me to take this risk and only make 0.5% of my account, I just don't think it's worth it. It's not even that. Honestly, I would gladly go for this position. The reason I didn't go is because, again, it's completely overbought, right? So I would rather wait for some kind of pullback, for something to tell me, okay, hey, we are taking a break for now, because this is just not an ideal situation. It feels like you've already missed the train, and price can keep going up. Obviously, this is not like the price is just definitely not going to go up anymore, but I'm going for the highest probability setups, and I'm not trying to guess what's going to happen in any case. I'm just trying to gauge where is there a higher probability of price not slamming down because it's just kind of overbought. So it will be a technical correction, let's say. But this is about it. I don't think there's anything too complicated here. I think it's just kind of getting to work, getting to know the fundamentals, which again, they're really not that complicated. It's just a matter of practice, and you can really get to a point where you average 50% per year, and you can make a good living from just selling options. Just need to get to work, be patient, and do a lot of reading. Because this is the business we're in. It's this business. People can flourish and people can completely destroy their account just based on their decision making, right? That's all it is. It's all about decision making, and that's about it. Thank you again for watching. If you have any questions, let me know. I'll try to answer them to the best of my ability, and I will catch you in the next one.